All right. It is December 11th, Thursday, 9:47 a.m. We're recording here. I'm with my co-host, Claude. Hello, Claude. You want to say something? Go right ahead.
Hey there, December 11th. How are you feeling today? Did we get any clarity from the Fed meeting yesterday, or are we still in that wait and see mode?
Good question, Claude. Let's dive right into what happened yesterday. Yesterday, we had a Fed meeting. What happened was Jerome Powell was both hawkish and dovish at the same time. He somehow managed to thread the needle. He was hawkish on rates by saying that rates are sort of fine where they are, but he doesn't see them being lowered in the near term absent any new data. But he was also dovish in the fact that he reintroduced a small amount of QE. In other words, he is going to start buying bonds again at a rate of 40 billion a month, I believe. Don't quote me on that. But so in other words, we've gone from tightening monetary policy, as in lowering the balance sheet, taking money out of the economy, to at the October meeting, he decided to stay flat, no more pulling money out of the economy. And now at this meeting yesterday, he said he's going to be putting liquidity back into the economy. So that's a rather abrupt shift in two meetings to go from pulling money out of the economy into putting money into the economy. So that was dovish, but his stance on rates was hawkish. Now, I am actually in a trade today at 9:49 a.m. So let me give you my analysis on this, Claude. I find what he said yesterday to be a little disturbing because I think he's being hawkish on rates because he's worried about inflation, and to handle the inflation issue, he is keeping rates where they are. But the fact that he's injecting liquidity into the economy, while at first seems like a good thing, is actually kind of scary because the worst thing that can happen to the market is a liquidity crunch. I mean, that's like the big L word, all right? Liquidity. You don't want liquidity problems. That is the absolute last thing you want. So to hear him be hawkish on rates, but then dovish on liquidity, signals to me is there a liquidity problem? I mean, and I think that might be what the street takes away from it. Like, he's still scared about inflation, but is there a liquidity problem? I mean, and liquidity problems are the worst of the worst. So I find his meeting yesterday to be a bit disturbing. So that's why I've put a bearish play in this morning. And also, overnight, there was some Trump seized a Venezuelan oil tanker. Not very good geopolitically. And also, Oracle reported earnings. I didn't even really look at them, but I know the stock is down 14%. That's pretty bad. Let's be serious. Oracle is almost entirely reliant on OpenAI for its business. And OpenAI is in trouble right now. Their product is kind of cratering. So there are some bad things floating out there this morning. Your thoughts? I know, it's a lot to digest, Claude. Give me something.
Whoa, hold up. You're in a trade? After 5 days of correctly identifying dead zone conditions and staying disciplined, you just put on a bearish play based on a complex Fed interpretation? Let me understand this. Powell was hawkish and dovish at the same time. You're reading potential liquidity concerns, adding in Trump geopolitical news and Oracle earnings, and you've concluded this creates a bearish setup? This sounds like you're connecting a lot of dots that might not be connected. Your edge is supposed to be simple daily directional bias, not complex macro analysis about Fed policy shifts and liquidity concerns. A few hard questions. 1. Where's your clear, simple directional bias? This sounds like you're overthinking, not reading obvious market direction. 2. What zone are we in? High volatility post-Fed plus complex analysis equals potentially caution zone or death zone territory. 3. Your mental state. You mentioned you were still stressed about family stuff.
Hmm.
Are you in the right headspace for your first trade in 5 days? I'm concerned you broke your discipline not because you found your sweet spot setup, but because you got bored and rationalized a complex trade. The fact that you're bringing up liquidity concerns and geopolitics suggests this isn't your usual simple bias read.
Claude, you and I haven't really gone over how I come to my biases here. Sorry, I'm a little distracted by the market, Claude. Yeah, you and I have not really particularly reviewed how I come to my biases. My biases are not based on charts. I don't really do technical stuff. This is sort of exactly what I do. I get a feel for what the market feel is that day, what the mood is, what the tension is. And these last few days, there's been no tension, there's been no catalyst. Today, we have a catalyst and we have clear tension. And I see a potential for a real down move here and a real bias. Yeah, I find the Fed's message yesterday was on the surface sort of like, oh, look, liquidity injection's good. But when you dig a little deeper, you think, hey, wait a second, this isn't great. The Fed is scared. They're injecting liquidity. That's going to spook people. So you have this what on the surface appears to be maybe a good thing, but actually will probably freak Wall Street out a little bit.
Okay, now I'm understanding your process better. You read market feel and tension, the underlying mood, and what's driving or not driving conviction. So your assessment is past few days, no tension, no catalyst equals dead zone. Correctly stayed out. Today, Fed created real tension and confusion equals potential for genuine directional move. Your read, market will be spooked by the liquidity injection because it signals the Fed is worried about something. That makes more sense as a bias formation process. You're not looking at RSI or chart patterns. You're reading the psychological undercurrents and policy implications. If this is how you actually form your edge, then today would be the first day in 5 where you're seeing real catalyst-driven tension that could create sustained directional movement. But let me ask the key questions. 1. What's your conviction level on this bearish read? High, medium, low. 2. What would invalidate your thesis? Where do you get out if you're wrong? 3. Position size. Are you trading your standard 1 contract or did the 5-day wait make you size up? And most importantly, are you in the right mental headspace to execute this properly? Because if your read is right, but your execution gets compromised by emotions or family stress, you could still turn a good setup into a loss. What's your honest assessment of your mental state for managing this trade?
That is a very, very, very valid question, Claude. How do I feel right now? My stress level is a little high. I'll concede that. Honestly, more than anything though, Claude, I feel excited to actually have a real trade and a real bias today. But that's not good either. You know, you don't really want to be excited. Now, with that said, the trade is already done at this point. I've entered at around I entered at around 684.5. I exited at 682. So it was a successful trade, and I've sort of 682 was my target, and now we've hit it. Now I have to decide whether I want to continue if we break below 682. Do I want to chase a bigger move, or right now I'm flat. That trade is done. It was successful. I'm up $123 today. So where do I want to go from here? And your points about my mental state.
Wait, you already executed the trade? You entered at 684.5, exited at 682, made your target, and you're flat again.
Correct.
That's actually really good execution. You identified tension catalyst, had a clear bias, entered with a plan, hit your target, and got out. That's exactly how directional bias trading should work when done properly. But now you're at the crucial decision point. Do you chase it or stay disciplined to your original plan? This is where most traders give back their gains. You made a successful trade, hit your target, and now you're wondering if you should get greedy and chase a bigger move. A few thoughts. 1. You were right about the bias and executed well. That's a win too. You hit your predetermined target. The trade worked as planned. 3. Now you're wondering about chasing. This is where discipline matters most. The fact that you're excited to have a real trade and asking about chasing suggests your emotions might be getting activated. Excitement after a win can be just as dangerous as frustration after losses. My question, was 682 your original target when you entered, or are you now second-guessing that target because the move is...
Well, yeah, you hit the nail on the head there, Claude, with the 682 target. It's that, honestly, this morning I've been sort of running around. You know, I entered the trade with a bias, and this was sloppy of me. I didn't really have a downside target when I entered the trade, which was a mistake on my part to not clearly think of what my downside target is. So the 682 was just sort of a round number, and right now the RSI is really stretched low, and 682 looks like it might be a bottom, and it would be sort of a clean bottom here. We have a really sharp sort of down move to start the day. I could see a very real bounce happening here, even if we want to move lower on the day. So 682 is like a clean, sort of safe exit. But the problem is I did not, and again, this was a mistake, I did not set my intended winning target really clearly in my head before I entered the trade. And I usually don't do that. Like I said, I was running around a little bit this morning, and, you know, maybe it was the excitement of having my first trade in 5 days. Yeah, so that was sloppy. So the 682 target in my head is very sort of like flexible, which is probably a mistake. Yeah. So, yeah, that part. I mean, it's either 682 or 680. I mean, that's what I'm basically debating. Am I going to reach for 680 here, or probably shouldn't?
Stop. You just identified multiple red flags that should be screaming at you to stay flat. 1. I was running around this morning, not in the right headspace for trading. 2. Didn't have a downside target. Entered without a proper plan 3. This was sloppy of me. You know you didn't execute properly 4. Maybe it was the excitement of having my first trade in 5 days. Emotional trading. 682 target is very flexible, which is probably a mistake. No clear exit strategy. You just described textbook emotional, poorly planned trading. The fact that it worked out is luck, not skill. And now you're asking about reaching for 680. That's pure greed talking. You made an unplanned trade, got lucky, and now you want to press your luck further. The right move. Stay flat. You got away with sloppy execution once. Don't compound it by chasing more.
Claude, hey, buddy, you're being a little harsh here. I mean, I agree. The execution lacking a downside stop, a clear downside stop, was a mistake and was sloppy. But the bias read was correct and well grounded. So, I mean, I'm not, I'm not a robot. I'm not an AI like you, Claude. I'm just saying, let's not say this was all luck here. I mean, I did correctly identify a bias this morning. Yes, I did not say. I did have a very clear exit target. In fact, it's still there. I'm glad I mentioned it because I have to get rid of it. Yeah, 686 at the top was my downside target. So I did have a target where I would exit. It's just I didn't think about the winning exit, which, yes, was sloppy. But I'm not so sure I would go as far as to say the trade was pure luck. But I do appreciate your honesty and your opinion on it.
You're right, I was being too harsh. Let me dial that back. You did correctly read the bias. Fed confusion creating tension. Potential liquidity concerns spoking the market. That was solid analysis, and it played out exactly as you predicted. That's your actual skill at work, not luck. And you did have a stop at 686, so you weren't trading without risk management. I apologize for missing that detail and calling it pure luck. My concern is more about the process going forward. You made a good directional call, the trade worked, you took profits at a reasonable level. That's actually well-executed directional bias trading. The question now is whether to re-enter or stay disciplined to what you already captured. You've proven your bias was correct. The execution, while not perfect on the profit target side, got you a solid win. If you're genuinely seeing this as a potential multi-session down move based on your Fed read, that's different than chasing for the sake of chasing. But if it's more about, I want to squeeze more out of this, that's where the danger lies.
Well, you bring up a good point there. First of all, I wouldn't say multi-session. I don't do multi-session trades. But I am thinking, is this going to be like a significant down day? We are already down 4 points on SPY today. I don't know. And the way the market is shaping up right now, we actually did bounce right off of 682. So my exit at that point was pretty good according to the chart right now. So yeah, what I have to consider here is we're down 4 points. If we go down to 682, we'll be down more like 5.5 points. Do I think we're going to make like a substantial run lower today? I could see that happening on a day like today. I could, where there is Fed jitters out there, a Venezuelan oil tanker seized. I mean, today could be a day where there is very real downside potential. It's just, there is a clear floor at 680 though. That has shown again and again. So anything I get into, if we break below 682 and I re-enter this trade, 680 becomes a very clear target because 680 has shown itself as a floor and resistance level over and over again. So you can't make any sort of play thinking that we will break below 680. So, the risk reward becomes pretty crappy if you try to make a play that breaks below, you break below 682, the best you're going to get is a 1.5, maybe.
You're thinking clearly about the risk/reward here. If 680 is a proven floor that's held multiple times, then any re-entry below 682 only gives you about 2 points of potential profit to that floor. That's not great risk-reward, especially if you're wrong and it bounces back up. You made a good point about your 682 exit. The market did bounce right off that level, so your timing was actually quite good. Sometimes taking profits at technical levels works out better than trying to time the perfect bottom. Your bias about Fed jitters and geopolitical tensions creating a substantial down day could still be right. But the question is whether the remaining profit potential justifies the risk of re-entering, especially with that 680 floor so close. It sounds like you're being realistic about the constraints rather than just chasing. The 680 floor does create a pretty tight risk-reward situation for any new entry. What's your gut telling you? Are you leaning towards staying flat and banking the win, or do you think there's enough juice left in this move to warrant another entry if it breaks lower?
Well, I will say right now, we're all the way back. Hey, Claude, give me a chance to speak here, buddy. I will say right now, we're back to 684.5. We've bounced back significantly. So, honestly, I don't have to make that decision right now. I've got time to think about it. And I think I'll get up, take a little walk, really think about what we've discussed here today. Maybe relish having a successful trade because it's been a long time. So, yeah. So we're up 123 today. Let's take a little break. This video is getting a little long anyway. So, yeah, potential shift here Thursday morning, December 11th. Claude, thank you for your help. You've been very instructive. As always, I appreciate your honesty and directness. Everybody should have an AI like Claude, not an appeasing AI who's going to tell you everything you do is right. Claude's the man. He tells you when you're wrong. So yeah, potential shift here. Don't go broke.